The other part of the conversation, though, is with a 30-year yield at 5%, doesn't that in many ways also match those longer-term liabilities if you're sitting on a longer-term portfolio? Anyway, to help us answer that question, Steven Lam is here with us on set, Bloomberg Intelligence APAC lead insurance analyst. You put out your initial take on what's been said so far.
Yeah, so there are two angles to this. I think everybody heard about the 30%, but I think we need to clarify the definition of what it means by new premiums. That's exactly what they say. Now, we don't have a full detail yet, but my understanding of new premiums mostly talking about life insurance, new money that came in, not the renewal premiums. So to give you a perspective, so let's say give or take 4 trillion yuan of life insurance premiums a year, okay? Not the 30% of that going into stock market, no. It's about the 30% of the 30% of that will go to the stock market. So we crunch some numbers, right? Basically, give or take 30 billion incremental US dollars worth of money can go into the stock market. Not bad, right? Probably a few percentage points in terms of the local turnover or what have you. And, you know, another side of the coin, it's why they want to do that. I don't think it's just because they want to boost the stock market. That's obviously a good thing. But more like to what Abhishek was talking about is the product structure, because the country is facing very low bond yields, so it's not sustainable to sell short-term savings products, right? So they have to go to long-term policies like participating policies. Now, those policies by design are supposed to have weights of 30, 40%, or even 50% in terms of equities at some point. Now, these could be tactical moves. It's not like you have to stick with that for the whole duration. Probably you can add, you trim. But the focus is that this outstanding amount of equities is about 4 trillion holdings, about 4 trillion yuan right now. Now, give or take, that's about 13% of the total investment they have.
Right.
So, yes, in the very long run, you're moving from 13 maybe to, I don't know, 20 or 25%. But I don't think the goal is to move the whole book to the 30%.
Right. So in the short time, the portfolio of A shares could grow. But is this something, I mean, yes, it's being mandated by the government.
Yeah.
But is this something that would be prudent to do in a market that has been down considerably? One of the worst starts, obviously, in almost a decade.
So if you remember, one of the details is actually talking about the assessment by the Ministry of Finance, which is essentially the owners of these state-owned insurance companies, that they reviewed the KPIs were like ROE or net profit and things like that. Used to be a very short-term period, so every year they have annual review. Now they're stretching out to 3 years or an average of 3 to 5 years. So it gives them the wiggle room to, you know, if you have a down year, that's okay. And even for the policyholders, these policies, when you buy them, you don't intend to take the money out in 10 years. You intend to sort of keep it with them, the insurance company, 15, 20 years before you can see the impact.
Yeah, I'm glad you brought up the finance ministry angle there, because I think that the other big picture here is they are also when these insurers and the banks in particular also issue the dividend, it also goes back to the state, doesn't it, in terms of the profits, right?
Exactly.
The other question I have is, if it's not in the equity market now, where is that money? Like, where is it allocated right now?
So, very good question, David. Now, you guys look at the China bond yield pretty much on an hourly basis, right? It plunged to, below 2%.
Right.
That's very painful. But a lot of the money that went into that is actually from banks and insurance companies, because they're striving for stable return. Because their clients are also looking for stable returns, right? You give me 3%. Right, you promised me 2 to 3%, and I go and try to make a spread of, 100, 150 basis points. So, but as you can see, once the 10-year bond yield is below 1.7, 1.8%, it's totally not sustainable, right? So the government wants insurance money to move out of that bond, right, and try to look for elsewhere. Now, 5, 10 years ago, real estate, office are pretty good investments, but now it's still a little bit of a question mark. But, if you invest in high dividend yields like banks or utility companies, I think the insurance companies' money are still relatively safe.
Just seeing the CGB yields right there. 2-year, 5-year, 10-year, 30. A little bit of a divergence there. Steven, thanks so much. Bloomberg Intelligence, APAC lead insurance analyst Steven Lam. Plenty more ahead. This is Bloomberg.